Welcome back to Alpha Recap. We're recording after the market close, and today we had a busy tape with some big portfolio moves, a space milestone, and a few headline-driven spikes. As always, if you have questions, you can reach us at stockalpha.ai and stick around because we'll tell you how to ask us directly after the show.
Good to be here. The market tone felt, well, mixed. There wasn't a single story that dominated everything, but a couple of large items moved positioning. Most notably Berkshire Hathaway's move on Kraft Heinz and RTX Corporation's shift in the investor narrative after a mini-satellite launch.
Yeah, let's start with Berkshire. The firm announced it was preparing to exit roughly 28% of its stake in Kraft Heinz. That is a really big block of stock to put into the market, and it had the predictable short-term effect. Kraft Heinz shares came under pressure as that supply was expected to land.
Exactly. When you've got a near 30% holder easing out, that's not just noise. It's concentrated ownership being turned into liquidity. It changes both the immediate price mechanics, more shares for sale, and the long-term story about who is steering that company's destiny.
People are parsing the motive here. Some called it prudent reallocation under new leadership, moving past what many described as a Buffett-era misstep. Others said it looked like capitulation, crystallizing a loss on a long-held position. Both views have merit.
Right. If you're a long-term value investor who believed in a multi-year KHC recovery, this might sting. But from a governance and capital allocation standpoint, freeing up capital to pursue higher return ideas is defensible. The key question is whether Berkshire's proceeds get redeployed into better opportunities.
And a quick practical note for traders. Mechanical supply from a block sale usually means volatility. If you wanted exposure to Kraft Heinz after today, sizing and staggered entry made sense rather than jumping in full tilt.
Good point. Now turning to RTX Corporation. Today the market started treating it more as a defense and space name. That was driven by Blue Canyon Technologies' launch of a Saturn II mini-satellite supporting NASA's Pandora mission. It's tangible proof of capability, but we should be careful about how big a deal that gets.
Totally. Mini satellites are interesting. They open addressable markets in civil and commercial space, but they don't instantly turn a prime defense contractor into a space juggernaut. It's optionality, access to new markets, potential recurring manufacturing or services revenues down the line, but only material if contract wins follow.
Exactly. Skeptics will say it's a distraction from core programs unless RTX can demonstrate repeatable revenue and margin expansion from these activities. Bulls will highlight the strategic diversification and the potential for higher growth, higher margin adjacencies.
Switching gears to energy, Chevron was reported to be closing a Singapore asset sale in the first quarter. We didn't get price details or buyer identity yet, so markets were left guessing whether proceeds go to buybacks, dividends, or general corporate uses.
Those asset monetizations are routine at majors, but timing matters. Completing a sale early in the year influences capital allocation conversations and could affect cash flow guidance. Until the details are disclosed, assuming an automatic boost to the yield would be premature.
On the healthcare side, Johnson & Johnson delivered product-led momentum. Their innovative medicine segment grew about 10% year-over-year in the fourth quarter, with Darzalex up about 26.6%. That's the kind of fundamental, revenue-driven, upside long-term investors like to see.
Product adoption like that affects margins and validates commercial execution. For J&J holders, the next checkpoints are pricing durability, label expansions, and reimbursement stability. If those line up, this becomes a structural uplift rather than a one-off.
Then we had Netflix, not a fundamental release, but a big behavioral blip. Searches spiked to about 50,000 queries, a 300% increase. That's the sort of social and search signal that traders watch for short-term volume spikes and increased intraday dispersion.
Important to underscore, a search spike is noise unless it's paired with subscriber, content, or revenue news. For quant desks and active traders, that kind of jump was a tradable flow trigger. For long-term investors, it's curiosity-driven volatility and not a reason to change the thesis by itself.
And finally, regulatory headlines. Jamie Dimon spoke out strongly against a proposed credit card rate cap, arguing that it would slam consumers. That comment pulled policy risk into the market conversation around banks and card portfolios.
This isn't academic. Caps on card rates affect net interest income and require banks to adjust risk-based pricing or tighten underwriting. Investors in bank credit portfolios were well advised to run scenarios modeling lower APRs, higher charge-offs, and compressed fee income.
Let's talk disagreements among market participants. On Berkshire's sale, some saw responsible stewardship, others saw capitulation. On RTX, bulls argued diversification. Skeptics warned of distraction. On Netflix, traders saw momentum. Longer-term players saw noise. On card caps, consumer advocates saw protection while banks warned of credit contraction.
Those splits are important because they determine positioning. If you believe Berkshire's move is prudent, you might redeploy capital into other ideas. If you think it's capitulation, you may short Kraft Heinz or avoid it. The investment action depends on which narrative you buy.
Let's break down why selling about 28% of a company matters in plain terms. If a big owner puts a large block on the market, they increase supply suddenly. Buyers have to absorb it. That basic supply-demand imbalance pushes prices down, at least in the near term.
And beyond price mechanics, it signals a change in conviction. It tells other investors the large holder no longer sees the same upside, which can alter sentiment and even governance outcomes at the company.
On RTX and small satellites, think of them as a new product line. They're exciting because they offer potential recurring revenue and access to different customers, like civil space agencies and commercial constellations. But until you see contracts, backlog, or margin lift, it's an interesting footnote.
Which brings us to the tactical playbook. For traders, Netflix's search spike was a clear short-term signal to expect higher volume and possibly wider spreads. For longer-term investors, J&J's Darzalex growth was a fundamental data point worth incorporating into revenue models.
We should also highlight the filings. There were multiple 8Ks and related filings today. If you're making decisions, go to the primary documents instead of relying on headlines. That's where you find the line item detail that matters.
Absolutely. And in practice, that means pulling the 8Ks, looking at the exact language around sales, lock-up windows, indemnities, and timing. Market moves often depend on the small print.
Time to map these developments to investor types. For long-term value investors, view Berkshire's decision as a prompt to reassess concentrated positions and be ready for multi-year recovery timelines if you stick with Kraft Heinz.
Income investors should watch Chevron's sale for how proceeds are used. Don't assume a yield bump until you see the numbers. And bank dividend investors should model policy risk from proposed card caps.
Growth and product investors should take J&J's Darzalex outperformance seriously and reevaluate revenue assumptions. In aerospace, treat RTX's space activities as optionality until you see recurring contracts and margin improvement.
Active traders and flow desks use behavioral signals like the Netflix search spike as short-duration trade cues, but manage execution risk. And event-driven investors, Berkshire's pivot could trigger secondary actions, activists, takeover interest, or asset redeployments. So watch filing windows closely.
A few tactical takeaways to wrap up. 1. Track the primary filings for the fine print. 2. Manage position size around mechanically driven supply changes like Berkshire's sale. 3. Separate behavioral noise from fundamentals. Know when a search spike is just that, not a change in earnings power.
4. Stress test bank and card portfolios for policy scenarios. Run sensitivities on net interest margin, charge-offs, and fee income. And 5. Look for confirmation, not just headlines. Revenue recognition, backlog, and segment reporting are the things that turn interesting headlines into real investment signals.
Bottom line, today's flow combined a major portfolio reallocation, strategic repositioning in aerospace and defense, and real product-led surprises in healthcare, all against the backdrop of behavioral and policy noise. That leaves the market posture neutral to cautious. Opportunities are there, but headline-driven moves and concentrated supply events demand defensive sizing and active monitoring.
Well put. Keep an eye on follow-up filings and next quarter reporting. The stories that have substance will show up in contract wins, recurring revenue, or chinchami. or sustained margin improvements. The rest will fade as traders move on.
All right, that's our wrap for today. If you want more detail on any of the filings or the modeling scenarios we mentioned, head to stockalpha.ai and use the Q&A. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next market close with another recap. Good night.